email you sent a few minutes ago to Mark, because I had called Manny because we had a couple of different invites for this same call. So,
Absolutely. Just resent the penalty.
okay, thanks.
Thank you. Thank you, Scott. I appreciate the kind introduction. So, like Scott said, my name is Manny Juarez. I'm president of RSV Advisory Solutions. And today I have Gary Wapinski, who is a CPA and COO, and also will be having Mark Belongia joining us here shortly, who's issuing counsel from Solus Private Equity. Both Mark and Gary are highly versed in the transaction, so they're joining us today just to be part of the discussion and answer any questions related to the opportunity once we get through this presentation. So just to kind of start from the top, this strategy gives clients the opportunity to purchase a convertible bond from an issuing grantor trust. And by purchasing the bond and converting the face value, you have the ability to get an above the line deduction equal to the amount of the bond you purchased. So I'm going to get started with that. My disclaimer, I'm not a CPA, I'm not a tax attorney. I'm simply a promoter of the strategy. We educate people like Scott and other people in my network and facilitate the purchasing agreement. Generally what happens is when someone says, yes, we're interested in this, I put together the buyer with the opportunity.
Yeah, and, just resent you the link.
And hopefully we'll solve your liability scenarios. So in the following conversation, what we'll do is we'll review really how all this happens. And then also we'll give a couple of examples of the numbers, because obviously the flow of money is very important on how this whole strategy works. And it's also very important if you're really looking to reduce your tax liability for 2024, and in the instances of what Scott said, 2023 and also 2022. This is the right webinar. So let me go here. So give a little bit of background on the opportunity. I'll begin just by saying it traces back to 2018. When investors of NHL Legal Care Trust invested in a hedge fund. This investment occurred during COVID, and obviously the investment failed. The 2020 CARES Act was a significant lifeline for many people, many businesses, and it's really what allowed for these NOLs to be 100% pushed forward. And these were reported to the IRS, the Internal Revenue Services, in 2020. So one important note for those that are not familiar with the CARES Act, in 2017, it had been scaled back to 80% of carry forward, and then the 2020 CARES Act went back and changed that to 100%. So that's just kind of a little bit of a background on how this is possible. Obviously, we're going to go through the mechanics on how this is all occurring. And then just to kind of take one step deeper into the CARES Act and how it impacted banks, this is essentially what really enabled the economic substance for the strategy, right? For those that are not super familiar with the CARES Act, it's really what gave the banks a lifeline. It obviously supported a tremendous amount of financial of the financial system and then the failing banks. And I don't know, for those that remember, like the PPP, right, was part of that forgiveness and reducing the default risk for banks. But essentially the CARES Act is the mechanism, well, part of the mechanism, and that really allows for the banks to carry back net operating losses and really improve their financial standing. Compliance. The product has been financially engineered to be able to fit with several aspects of the code. Here's a couple of those that what this is aligned with. So we have the grantor trust structure, which has been in place since 1954. And then there's the notion of principal contracts and the credit default swap. So this is, I'm sure, Gary, you'll go into this deeper, but it's the simplest form of transaction which hedge funds have been using for the last 100 years, for this to be changed by Congress, then the tax law with respect to grantor trusts would also have to be changed by Congress. However, about 75% of the people in Congress have a grantor trust. So we don't anticipate Congress shooting themselves in the foot in that way. But beyond that, compliance with the Internal Revenue Service since 2020, which is the time that these losses were reported, but more importantly, the amount of the losses were also reported, and these will continue to carry forward until exhaustion. And then, of course, it's not a listed transaction, which falls within existing tax laws. Key parties in the structure. It's important to know there's basically three elements to this. We have the grantor trust, which in this case is NH Legal Care Trust. This is where all the assets are held currently. Then we have the issuing trust, which is equity linked, which issues the bonds. And then lastly, we have the operating company, which is Solus Private Equity, who originate the bond sales, and some of the loan transactions. So in a nutshell, that's kind of the mechanics of the who's who on this with this opportunity. So for those on the call, obviously it's a really important part of the year. So this opportunity offsets all income types, as you see here listed. Obviously W-2 is a big one for some of the audience. Capital gains, partnership advances. If you're exiting a 1031 exchange or you're having an early pension withdrawal, it's applicable to pretty much all that. Here's how it works. Quickly go through just the general, A through Z's. But it's simply, the bond is purchased. The bond transaction, just as a side note, it has an indemnity financial guarantee built into the transaction. So this is for anything and everything that may come up, and Gary will elaborate on that at the end here. But then number two is then you just convert the loss and receive an above the line deduction. So you're essentially offsetting your income by claiming the NOLs, and then you'll receive a refund of taxes paid or receive a 25% savings on taxes due. So a few clients that Scott and I have been talking with love the opportunity, and they're getting very strategic on being able to potentially go back, because this does have the approval to go back to 2022. So it's something that people are considering. I want to talk really quick about the money flow, just because it's important to understand how it all works. And then of course, once we're completed with that, we'll chat with Gary and Mark, who's also on the call now. But essentially, here's a screenshot. Hopefully you can see the figures on your side. But essentially, the yellow column is no tax planning, right? Just we're taking the example here of a married person filing jointly in the state of Alabama, and doesn't have any FICA, any self-employment, but you see that the business income is $750, W-2 $250. So all in all, they're all in at a million bucks. On that million, they have a total federal tax liability of $296, and then they'll have a state for $49. So if this individual did nothing, they're all in at $346 on tax planning, on their tax liability. So if we go over to the blue column on the top line, 2024 tax liability, that's the same number that you see there on the bottom left of the yellow column. So 346 is essentially the tax liability. The interesting part about this strategy is it applies to both, right? So we're lumping federal and state. So essentially the mechanics happens as you're essentially you're purchasing a bond for 75% of your total tax liability due. So that's why you see that total for the bond purchase amount.
Yeah, this is Mark. Sorry to jump in, but that's unique about this, that it actually does state and federal, which is most of these tax mitigation strategies only do one or the other. So that's really, really unique and cool about this whole program. It covers both.
Right. Yep. Thank you.
When you're speaking about the federal tax liability, it's only the federal income tax liability, which is the first line on page 2 of the 1040, because there's other taxes after that, such as self-employment, additional Medicare, the additional Obamacare tax, those don't enter into the calculation. Only the federal income tax liability and the state income tax liability.
Perfect, perfect. So with that being said, as you can see, it's a great solution, right? If you need that. So essentially, and in the last part there on the net savings, you basically instead of paying the 346, you're paying 75% of that, which gives you a net savings of 86K. So I share this just to kind of have a macro understanding of how the numbers flow. Beyond that, obviously there's some very strategic advantages around this, and some of them I mentioned. But really, the CARES Act advantages is obviously the primary one. The ability that these NOLs can be carried forward at 100% value. And then there's retroactive application, right? Which for some people on the call, that might be very important, or you might be thinking about that, or maybe you haven't thought about that, and this could solve for it. And lastly, it's just a clean 25% net savings, right? So that's really the overall advantage for those that want to get involved. The other great thing about it is that this has been meeting IRS compliance. It's been in effect for over 4 years, and then also there's the indemnification built into the product. So, and I think I mentioned that in the previous slide, but anything that happens, it's going to be taken care of by the trust and Gary's team. So that's a great thing that we always look for those kind of things when we're evaluating different strategies about audit protection.
Can
Mark, did you
I
want
jump
something?
in here because we have a couple
Yes.
questions, and I was
Yes.
answering the
absolutely.
questions. One was from Dennis. Where the IRS code me, we authenticate what you're suggesting. I have some liability as a friend to this person. So where in the code? This is all laid out in the code, and there's opinion letters that actually I wrote as a lawyer admitted tax court, that has written the opinions, which if you haven't seen it, you'll get that information. And Gary, if you want to jump in on that and talk about where in the code, but it's all under the code.
Yeah, we're simply utilizing a couple aspects of the code that the billionaires have used for a long time. In this case, we start off with a notional principal contract in its simplest of forms, and then.
And let me interrupt you, Gary, for 1 second, because Gary's his CPA, I'm a lawyer, so we're coming from the accounting legal side, so you're getting both parts.
Yeah, so then the notional principal contract in its simplest form, because the hedge funds use hundreds of them, some of them extremely complex. They actually intentionally challenge the IRS and tax court on those complex ones and win 75 to 80% of the time, where then it becomes part of the code. In our case, it has the credit default swap with it. Those two components provide the required economic substance. And then the securitization of the convertible tax bond was done through a broker dealer that represents the Palm Beach Hedge Fund Association, which is why then, it starts off with the notional principal contract. And then the bond itself is embedded in the notional principal contract. So then, once you go through the process of getting an offer sheet, and then if you want to move forward a subscription agreement, then the bond, page 5 of the bond, is a simple conversion page where you're just saying how you want to be entitled as a beneficiary of the grantor trust, which is where the loss emanates from. And then once you're a beneficiary, that's how you're able to get the loss, which is an ordinary loss that goes on Schedule 1, line 8Z. We provide an addendum to that has a couple of the code citations. And by being a beneficiary of the trust, that eliminates any issues that the IRS would normally have with respect to what's called transferability. By having that ownership interest, then there is no issue with transferability. And then the bond, I should say, Mark will chime in, is somewhat of a misnomer, because a lot of people think, okay, it's a corporate bond, it's got a coupon rate, et cetera, et cetera. In this case, it was simply securitized to go from point A, the notional principal contract, to point B, the beneficiary of the grantor trust. It's extinguished when you convert it.
So
That's correct.
So
And also, we have another question. And Gary's going to help me with this. How are you going to claim a loss in excess of basis? Well, there's no basis because you're buying the bond, which is a loss. So if you want to answer that question, please.
Yeah, well, that's a great question. Some CPAs will ask that, and all the tax attorneys will ask that. So in my typical example, you've got adjusted gross income of $1 million. So you've got 400,000 of federal income tax and state income tax liability. You buy the bond for 300,000. So then there's that difference of 700,000. In this case, the grantor trust picks up that 700,000 difference as ordinary income on their return using ordinary rates, which in essence, the IRS is getting more money than it normally would if the grantor trust recognized that using trust tax rates. So that eliminates any question the IRS can have from that standpoint. So you're paying the 300 and then the 700 differential in that example is being taxed as ordinary income by the grantor trust itself.
And to go beyond that, the grantor trust is involved in other aspects of business, right, Gary? That allows the grantor trust to then offset some of the income based on the losses of the grantor trust. So at the end of the year, people are like, am I getting a K1 or 1099? What am I getting? You're just getting a letter from the grantor trust that you put in your file. You have nothing more than that.
Right, yeah, in the form of the collateral certificate
Yeah.
and then the amendment to the trust agreement. That
Exactly.
comes after you convert the
Yeah.
bond.
Yeah.
And the process, we've actually had some people do the whole process in one day where we
How
provided
do
an
you
offer sheet
spell it?
early in the morning. They decided they wanted to move forward. We gave them the subscription agreement. They wire transferred the funds. We then emailed them the countersigned subscription agreement and the bond. They did the conversion page, sent it back, and we had enough time that day to give them the collateral certificate and the amended trust agreement. Now, when we got into the first 2 weeks of October, we weren't able to do everything that quick because the volume was
It's
just
a lot. The
like
volume
through the
spiked.
roof.
Yeah.
Yeah, and surprisingly, it's still busy today, and already people
But also,
are.
Gary, I want to bring up that, we got stuck a few times, but we got stuck on not the product, but other reasons. So talk about, identity
Oh, you mean
theft,
with
etc.
the IRS?
Yeah.
Yeah, so the IRS, they have many algorithms, and one must be that when someone is getting a large refund upon amended return, they want to make sure that there's no identity theft involved. And as probably you're all aware, our social security numbers have probably been sold dozens and dozens and dozens of times.
Yeah.
I got hit with the identity theft on the taxes about 8 years ago when I got a letter from the IRS questioning something on my return, and I'm like, I didn't even file a return yet, so what are they questioning? So it ended up somebody stole my identity, filed a return, got a refund, and then I spent about 45 minutes on the phone with the IRS having to, answer their questions to verify that I am who I am, but the bad
Right.
guy didn't have to verify anything.
Yeah, and I just put up the slide of the actual process because I was actually getting towards the end of our conversation here, Mark, on my presentation. But really, one question that I did want to address with you both on the call. Can you talk a little bit about, Gary, on people that are evaluating getting their amendments or submitting amendments for 2023 and 2022? Maybe what that process has looked like for you as of recent, and then also timing, right? Because a lot of people are thinking more holistically around it, of what they can do if they want to start with 2022 and roll that up to 2023 and so on. So if you can touch on that point, that'd be great. And I'm going to just shift to the last slide if you guys are on there, for getting like what Gary mentioned, a no cost quote. You can simply just those are the 3 items we need via email, and you can surely just send me an email on the QR code. But I really want to talk about that question, Gary, if you can elaborate on that.
Yeah, well, this one here, and in some cases, we're also needing taxable income in addition to adjusted gross income. And we don't do, you know, all the calculations involved in a return because some of the returns are 400 pages. But
Right.
if they've got a tax preparer that is willing to, you know, push through certain amounts of a loss to see what it looks like, because we've got several tax preparers that bring in a lot of clients that actually also bought the bonds themselves first, but they run different scenarios through their software to see
Okay.
what's going to work the best, because there's a lot of different nuances, you know, from one taxpayer to the next, especially now with the qualified business income deduction.
Mhm.
We've heard from tax preparers in some cases they weren't going to get it before they, you know, reduced their adjusted gross income. Then we've also heard the opposite, where it's wiping out any benefit they got from the QBID. And that only happens when there's a fairly significant difference between adjusted gross income and taxable income.
Understood. Got it.
Yeah, so then you wanted to go back to the previous page?
No. This is I was saying this is when Mark jumped in. I'm at the tail end of my slide presentation before we actually
Oh, okay.
put it up
Okay.
to more of the questions, because I can't see the questions on here because I'm on full screen. But I'll leave this
Oh,
up,
okay.
Scott. Scott, you want me to leave this on right now?
Yeah,
For now?
leave that on, and I just put your calendar link also in the chat, so
Perfect.
people
Okay.
can set that up with you. So
Okay.
basically, a very short summary, so that for people like me that like to keep it simple: organization bought a bank, bank fell, billions of dollars of losses, and through all these legal opportunities, along with the CARES Act, others can join into the trust, buy into the trust, get the bond, and participate in those
Well,
losses.
it's important. I got to interrupt 1 second. Gary's going to talk about that for a second, where the losses went from 80% to 100%. Gary, talk about that.
Yeah, the 2017 Tax Act, which really wasn't put together properly, it was redone after the fact. But because of that reconciliation process, you know, you ask for an additional benefit and then you have to take something away. So they, you know, went from 100% deductibility of net operating loss carry forwards to 80%. Then the CARES Act bumped it back up to 100% at the request of one of the hedge fund billionaires. And so that's why, you know, we're confident with, you know, what we're using on that part of the code, as well as the grantor trust. Congress would have to change those that have been around forever, and on the grantor trust, we don't see them shoot themselves in the foot and changing that, because probably 75-80% of them have one. So, you know, we've just adhered to the code, used the quote unquote convertible tax bond securitization, again, to go from point A to point B to make sure we're in compliance with the code. As Mark said, you know, it's 4 years plus. There hasn't been any questions other than, you know, the identity theft one on the returns. Oh, okay, yeah, then Manny, you were asking. So, you know, we don't control what the IRS does, and many people don't even know that most people that are employed by the IRS are still not back to the office from COVID. So that has slowed things down a lot. But prior to October 15th, we were hearing from the various tax preparers that had clients that bought the strategy that on a return on extension, they were getting the refund in 3 to 4 weeks, which is quick.
Right.
That's for 2023. 2022's, we're still waiting to get some feedback. We had a tax attorney do it for himself and probably had 30 clients do it. So I'd probably be talking to him over the weekend. But those were running, the IRS used to say like 16 weeks, but it seemed like they were taking at least 6 months. And then, to go further back, like 21, we've had a few people do that after we told them it's typically taken 12 months. But then once the end of November hit, the IRS is no longer processing electronically filed returns. That won't start up again until sometime toward late January because
Okay.
it's the government.
Yeah, it's down. Yeah, no, I'm aware of that. Yeah. So just to recap and make sure that I understood you correctly, for amendments, if you're doing 2023, it could be anywhere between 8 to 16 weeks, and 2022 anywhere between 4 to 6 months. Is that a fair kind of time frame?
Well, that was what we were hearing before the October 15th filing deadline. So then typically those numbers change, and again, we haven't gotten enough feedback since then.
Okay. Also, I want to interrupt for a second. Gary, I want to comment because this has come up before. How is it a carry forward versus carry back? So it's an important,
right.
Part of it.
In my notes. So Manny had suggested it's retroactive, and it's technically it's not, because it was filed with the IRS in December of 2020. So it's going forward from that. The election was made simply to go forward from 2020. So that's how taxpayer now can still utilize it, if they want to wait that long.
Right.
The reason being is they're becoming a beneficiary of the grantor trust. The grantor trust recognizes
still working
in
forward,
2020, and so you're a beneficiary of the grantor trust from that time, and it's a carry forward. Because a lot of times we hear that, like, how do you go back to like 21, 22? Doesn't make sense. Yeah. It's like, well, here's why it makes sense.
Yeah. And just to add to that, Mark, I see one of the questions because I just finally figured out my screen here to see the questions, and I had Betta Edson ask the question, in the past 4 years, has the IRS challenged any part of the strategy, including but not limited to audit of return?
Yeah, and I answered that, and I said, no challenges, no audits.
Got it. Okay. Thank you.
Not saying there won't be.
The
Again, the lawyer part of me is saying there's no guarantee of anything. But as we sit here today, again, there's been no problems except for identity theft. That's the issue we've been stuck on, and we resolved it when you call in and say, my first car I bought in 91 was a black Renault. Okay.
Right.
My mom's name is Carolyn.
Right.
And they're like, okay, that's you. You're good.
Okay. So generally, it's just to validate the profile, right, and validate that it is.
Well, it's only because of some substantial returns. I'm talking, 7 figures plus, right? And so the IRS, which is I don't have a problem with, is verifying those dollars are going back to the right taxpayer, not China, North Korea, Ukraine, or whatever.
Yeah, that's the same thing.
That, it's not a scam.
Right. Yeah, that's the same thing that for those of you that were maybe on the earlier webinar this week on our other strategy, that's been the same case. A lot of times they're reaching out for confirmation of profile and name and all that to make sure it's the right individual, because it is substantial refunds at sometimes depending on the individual. So thank you for that, Mark. So Scott, you have something to say, Scott?
Question for you. Yeah. So is there a max or cap on how much one can participate in? Also, if somebody maxed out on, say, a Section 179 max, 1.22 million, does that impact or does that conflict with this? Can we use this for the balance of the income taxes that we're not being?
Yeah, that's a great question. Yeah, it can conflict with that, plus the 5-for-1 charitable deduction. We had now two people where they previously bought the charitable deduction and then they wanted to buy the bonds, but on that charitable deduction, you're limited to 50% of adjusted gross income. And then there's no benefit from that bond on the state income tax side. So then he decided, we did the numbers and he was saving more money buying a bigger bond and then carrying forward half of his charitable deduction. And then at the end of the day,
Right.
he would have just saved more money and gotten a better return by doing the bonds versus both the charitable and the bonds. So yeah, that's where there's a lot of interplay because there can be a whole lot of variables with somebody's return as compared to another, and then you can get into alternative minimum tax and a whole host of other things, which is why it's always best then to have someone that's interested. We can, give them a couple of different numbers that they can have their tax preparer run with their software to see how it's going to impact those other things they may have.
And then there's another question I just put in there because I was talking to a tax professional yesterday about this. Can corporations themselves, people doing W-2s and having a business, but can a C corp or an S corp, the
Yes.
corporations go back?
Yes. I see answered it on the. I'm in the chat. I'm watching. Gary's talking and I'm doing the chat.
Got it.
Okay, there you go.
I already answered yes. No,
Okay.
obviously you got to see all the information, but the answer is yes.
Okay.
Yeah, and I posted that to you guys so that everybody did see that answer. So
Yeah.
I want to make sure it was brought up.
Perfect.
Yeah, no, all good questions, and yeah.
And again,
it's just-
Gary talked about capital gains, W-2, all forms of income tax can be offset by this product.
Yeah, and who it's really beneficial for. I did an offer sheet earlier today for an NBA player because they only have W-2 income, and then a few years back, Congress passed a law saying they can't, have any deductions, which is crazy. So yeah, this works for any type of income, and then in some cases, people may want to use it, in their subchapter S or partnership account, especially if they're 100% owner of the company, where they can use the face value of the bond to increase their capital account. So let's say they, buy a bond with a face value of $1 million, they're then able to take the next $1 million of income tax free. And also then we've got a few people now where they're, looking to sell their business. And, one guy's got about a $23 million gain. So then if he buys it to increase his capital account, he's again saving a whole lot of money on taxes. Then we've got another group that actually found out about us maybe a couple of weeks back. They paid $40 million collectively in taxes, on October 15th. So they're looking at potentially amending and then saving, obviously, a huge amount of money collectively.
That's really good.
That's really great, Gary. One quick question. Well, one question that comes up, Gary. Maybe you can share since everyone's on the call. How long is the runway of these NOLs? Like, if someone says how much is left, and they have something.
A lot.
how do
I
you-
would jump in on that.
Okay.
We have another like 3 billion of
Okay.
these NOLs. So
Well,
it's
yeah,
not gonna, like,
NOLs plus amortization expense,
Yeah.
which is a non-cash
Okay.
expense, but
Yeah.
it can all be done the same way.
yeah.
Got it. Okay, so there's a long runway. So people that are planning,
Yeah.
because I know people are planning and trying to, do their due diligence. They have time, obviously.
They have time, but they're getting eaten up left and right. You know,
Right.
working on a deal right now that, you know, a company is looking to take 500 million of them. So it's not forever.
Right.
No,
So
and then
when
an
that
earlier,
company is
Come on.
mandated, there will be a little bit left.
Well,
There's
yeah,
more left. There's more left because obviously we got to transact on that, but it's not going to run out tomorrow, the next day,
Right.
but it's
Yeah.
not forever.
Right.
well,
Absolutely.
yeah, we're working on a couple other transactions where it could keep going, but that's more complex.
Yeah.
But then an earlier question, what year they should do first. Well, at this point, they should, if they're interested, do 2024 and get that money back, within 3 to 4 weeks once they can start filing 2024s. And then if they're interested, they can go back and look at 2023 because at that time, that one's probably going to take closer to 6 months once the IRS is starting the process to 2024s.
Right. Okay.
Now
Yeah.
so as I understand it, you can go back 3 years, but only as long as you're within the tax filing. So we get into 2025. If somebody actually filed on April 15th of 2020,
Oh, yeah. There's a statute of limitations on amending that, it depends on when it was filed and when the money was paid on, whether they're still able to go and amend.
so if they filed the 24, then it may be worth it to go jump back to the 22 to stay within that range and then go to 23 since we have time.
Well, yeah, just that again, they have to be patient because that 2022 starting, once you're into January is probably going to take, close to a year because again, without having everybody back in the office, we've had tax preparers say they've called to see why the return hasn't been processed yet. And
Yeah.
the person from the IRS says, well, because right now they're answering phone calls and they're supposed to be processing returns. And they said, everything's getting backed up.
Right. No, that makes a lot of sense.
This is great info.
Yeah. Absolutely.
Yeah, and then as you probably know, then this is exempt under Regulation D 506C. So everybody that is interested has to be an accredited investor.